Welcome to EKO201E, Economics. I'm Chris Hannum, and this will be lecture 20 on the monetary system and monetary policy. The first thing we have to talk about, before we can talk about monetary policy, how governments intervene in the monetary system, intervene in the market for money, and how the monetary system itself works, is what money is. That may seem obvious. Money is a bill. It has a guy's face on it. It's worth 10. Now, that piece of paper being money is quite a new innovation in the world of money. Now, imagine a world long, long ago in which those pieces of paper didn't exist. There was no such thing as money at all. I say we go back 5,000 years, 6,000 years. Now, without money, we still have an economy. We still have transactions occurring between individuals. We still have some people specializing in farming and some people specializing in livestock herding, and they trade with one another. But the transactions that they make are barter. That is, one person needs to trade away wheat for somebody else who's selling goats. Now, if you have wheat and you want to buy goats, you don't just need to find somebody who's selling goats. You need to find somebody who's selling goats who wants wheat. And once you've found that person, then you can negotiate over a trade, over a transaction. But what if you have your wheat and you can't find anybody who has goats and wants wheat? All of the people who have goats want other things, but not wheat. Well, then no transaction occurs. Maybe you need to first trade your wheat in exchange for tools, and then trade those tools for a goat. Now, that's much more difficult than simply engaging in one direct trade between people. What we call this, the idea that if you have wheat and want goats, you need to find somebody who has goats and wants wheat. We call this a double coincidence of wants. People have to have and want the mirror image of each other. Now, in a barter economy, the need for a double coincidence of wants limits the number of transactions that will take place by increasing transaction costs. So it causes the economy to be small, relatively speaking, to what it would be if we didn't have this problem. And the way around this problem is by finding some kind of a medium of exchange. That is, something that I can always sell my wheat for, that person who has goats will always want. And that person who has goats can always buy this thing and then exchange this thing for whatever they want. There's no need then for me to find a specific person with goats who wants my wheat. That's the fundamental role of money as a medium of exchange, but that money could fundamentally be anything. That money could be pieces of gold, that money could be shells, that money could be huge stone wheels or deeds and titles to them. That money could be pieces of paper with somebody's face on them. As long as that other person who has goats is willing to accept this money, then I should be willing to trade away my wheat to get this money, knowing that I'll be able to use it for whatever it is that I want to buy. So the first fundamental purpose in the ancient economies of the world of money is as this medium of exchange, something to facilitate these transactions occurring so that we don't have the problem of the double incidence of wants. But that's not the only thing that we would like from an ideal form of money. For something to be money, or to be a good thing to use as money, a good thing to use in an economy as a medium of exchange, it should also be a good unit of account. That is to say, it should be easy for me to determine how much of it I'm getting, and to set a price of a good as measured in that. So it's not necessarily easy for me if we try to use, say, goats as our medium of exchange. Say everybody wants goats, so I can always exchange wheat for goats. People can exchange tomatoes for goats, therefore I can exchange my wheat for goats that I can use to buy tomatoes, because all goats are not the same. And because goats are not all the same, it's difficult to say that 1 ton of wheat is worth some number of goats. Are they male goats? Are they female goats? Are they 1 year old? Are they 4 years old? What's their color? How much do they weigh? So goats, although they could be a medium of exchange, if everybody wants them, they can't be a unit of account because they're not all the same. So they're difficult to use to measure. Gold, on the other hand, could be a good unit of account if we could measure the price of wheat or the price of goats or the price of tomatoes or the price of anything else in something like grams of gold. So provided we can weigh it, we can measure prices in it. We can use it as a unit of account as well as a medium of exchange. But again, it can only function as a medium of exchange if everyone is willing to accept it, if everyone wants it. Now, the third thing that we would like our money to have, the third feature, is to act as a store of value. This is another problem for goat money. Goats don't necessarily hold their value over time. I have to continue to feed a goat. That's expensive for me to continue to maintain a goat. A goat could get sick and die. A goat could get old while I wait to spend it on something. As a result, goats aren't necessarily a very good store of value. But gold, on the other hand, gold would be an example of a form of money that would not only meet the characteristics medium of exchange, unit of account, but would also be a good store of value. So gold wouldn't degrade over time. We could have exactly the same amount of it in the future as we have right now. Goats, potatoes, they might be things that everybody wants, potentially, but they're not as good as to use as a store of value or a unit of account, which is the reason that we tend to see money first appearing in the form of precious metals, things that don't degrade over time, therefore act as a good store of value. Now, the original forms of money from thousands of years ago, in those first countries or economies, kingdoms, in which money was developed, used a commodity money. And this comes directly about from the idea of using some product, like a goat, that everyone wants as a medium of exchange, if everyone wants a goat, to something like gold, if everyone also might be willing to accept this as a medium of exchange. Now, these commodity monies are valuable specifically because of the commodity that's contained. So, gold might be exchanged as money with the face of the emperor on it and certain writing on it. It might be a gold coin minted by a government, but it isn't the emperor's face on it or the writing on it or the fact that it's been minted into a coin that gives it the value it has. It's the amount of gold inside it. And anybody anywhere would be willing to accept it or would weigh it and determine that it had a certain number of grams of gold and treat it as such. Now, commodity money isn't for the most part the kind of money we use today. No, if we have commodity money like gold, for us to add more money into our economy, say we don't have enough to go around to engage in all the transactions we want to engage in, we don't have enough gold to make all the necessary coins, we wouldn't be able to find more unless we find it in the ground. We wouldn't be able to make more gold coins without finding gold in the ground. But today we use something called fiat money. Fiat money is money that doesn't derive its value from a commodity contained inside it. So it may still be a coin, and it could look very much like the coin that was made of gold, but the value of the coin doesn't come from the value of the metal inside. It could be made of metal which is almost worthless otherwise, that nobody would be willing to pay a very high price for at all. And the government who minted that coin tells us how much it's worth. We don't need to weigh it, see how many grams of nickel or grams of copper are contained in that coin to determine how much we should value it at. So, if fiat money has no intrinsic value, but the reason that commodity money had value at all was because of that intrinsic value, why does fiat money have value? Fiat money, like the Turkish lira, or fiat money like the US dollar has money because everybody believes that it has money. Fundamentally, as long as everyone is willing to accept it because everyone believes it has value, it continues to have that value and it continues to function as money. It continues to function as a medium of exchange, it continues to function as a unit of account, and it continues to function as a store of value over time, provided that everyone continues to believe that it has value. But its value is not intrinsic. If everyone were to en masse suddenly stop believing that the US dollar had value, it would stop having value. It's not like a gold coin that contains gold, which would contain value even if we didn't treat the coin itself as being particularly meaningful. When we talk about monetary policy next, we're going to talk about something called the money supply. And the money supply refers to the total amount of this money, whatever this money is, that's circulating around our economy. In ancient Rome, maybe this money supply was a number of silver coins or gold coins, and the weight of them in grams floating around the entire economy. In the US economy now, this is a number of dollar bills floating around the economy. We can call this a money supply, or we can call this a money stock, and those terms are interchangeable. So what should be included in our total measure of all of the money that's available in that economy? Obviously, currency, that is the physical paper bills, a paper $100 bill or $20 bill or $1 bill or 1 penny coin. Those would all be currency. Those are obviously all part of the money supply. Now also, we might have money, currency, that we took and deposited in a bank. So we no longer have that money ourselves. The bank now has that money. But because we could get that money out of the bank whenever we want, if we can get that money out of the bank whenever we want, we might consider that also to be part of the money supply. It wouldn't leave the money supply just because we took our $100 bill over to Ishbank and deposited it in our foreign exchange account. Now, these are called demand deposits, in contrast to other forms of deposits that we might have in a bank, specifically if we can take that money out of the bank whenever we want. Another way we would describe these demand deposits as being a liquid form of currency, as opposed to illiquid. These illiquid assets are things we can't easily get back or can't easily get out. Next, when calculating the total size of the money supply, we might use a measure called M1, which is relatively more limited and might include only currency and demand deposits and a few other types of very highly liquid financial asset, such as traveler's checks. There aren't that many traveler's checks out there, so it's mostly demand deposits and currency. And we can contrast that with another broader measure of the money supply we call M2. M2 includes everything in the narrow M1 and also certain other categories of financial asset and deposit that are less liquid. Savings deposits, other small time deposits, money market mutual funds. These are things which are less liquid than demand deposits, but still relatively easy for us to get out if we want access to our money. Now, M1 is only about 1/4 of the size of M2, as there's a lot of money in these money market mutual funds and savings deposits and things like that. But when we talk about money supply, we're not going to really draw any meaningful distinctions between the two. We won't say whether this is an M1 or an M2 measure. We'll treat them as almost interchangeable. Because the last you'll hear about M1 versus M2 is really right here. Now, what we want to talk about is how this money supply is managed, what we do to increase it or decrease it, and why we might want to. And the entity in an economy, usually a part of a government, but a largely independent part of a government, is called a central bank. The central bank is the part of the government responsible for monetary policy or economic policy which targets the money supply, with certain goals that are given to a central bank, such as ensuring price stability, or reducing unemployment, encouraging economic growth, or protecting the exchange rate of the value of the domestic currency. In the United States specifically, the central bank is called the Federal Reserve or the Fed. So when we say Fed here, we mean the Central Bank of the United States, which behaves very much like the central bank in every other country in the world. Monetary policy is conducted differently for different central banks, which are responsible for different currencies. In the United States specifically, the structure of the central bank, of the Fed, is such that it's run by a board of governors with a single chairman. That board of governors has 7 members and usually tries to reach decisions in consensus. Those board of governors are located in the capital, Washington, D.C. They also have 12 regional Federal Reserve banks spread around the United States, in addition to that one central Federal Reserve Bank. These 12 regional Federal Reserve banks all have their own governors, and they participate on the Federal Open Market Committee, or FOMC, which is what meets to decide on policies to regulate the money supply. The Federal Open Market Committee includes the Board of Governors of the main Federal Reserve and also the presidents of regional Federal Reserve banks. So there are more people on that committee than there are on the Board of Governors. So we want to talk a little about the structure of the banking system and as it will relate to how a Federal Reserve or central bank can influence the money supply by interacting with banks. So we describe the type of banking system that we have in Turkey or the United States and other countries in the modern economy as a fractional reserve banking system. Now, reserves for a bank are some amount of money that you have deposited, that you have saved in that bank, that the bank continues to hold. They don't loan that money out. They don't use it to buy other kinds of assets that could earn a return. They keep it in the bank in some vault just to be safe. Now, the Fed or other central banks, among other duties, establish reserve requirements, which are minimum amounts of reserves that banks can have. Of course, if you want to go to a bank and get your money out that you've deposited there, and that bank has no reserves, that bank has no money to give you, and that's a problem. We never know quite on any given day how many people will come to the bank trying to get their money out. It may be more on any given day than people coming to put money in. So the bank should need some reserves just to be stable, to not have to tell people on any given day that I'm sorry we don't have your money. Banks could choose to have more than the mandatory minimum reserves, but they often would not want to. The mandatory minimum for reserves would be money that they can't use to earn a return, so a higher rate of reserves in that bank, although it would make them more stable, would mean they have less return, less profit, less bank revenues. If they loan that money to someone else, then they get an interest rate in return, and it makes the bank more profitable. Now, the actual reserve ratio that the bank does choose, which may or may not be equal to the mandatory minimum reserve requirement, is R, the true reserve ratio in the economy. We call that reserve ratio R, reserve ratio, because it's the amount of reserves that the bank actually holds, divided by the amount of deposits. That might be, for example, 10% of all of the money that's deposited in that bank, or 20% of all of the money that's deposited in that bank, or only 5% of all of the money that's deposited in that bank. Now, to explain how this works and the effect that it has on money supply in the economy, let's look at a simple accounting framework called a T account. It's a simplified accounting statement that includes both assets and liabilities, in this case for a bank. Now, suppose that you've made a deposit in a bank. That deposit is $100. That $100 for the bank is a liability. Now, for you, it's an asset. It's your money. But for the bank, they have borrowed your money. And you could get it out at any time. They owe that $100 to you. So for the bank, that's a liability. That's a negative on their T account balance sheet. Now that bank might have assets as well coming from that deposit that you make. If they have a fractional reserve banking system with 10% reserve ratio, then $10 of that $100 would be held in the bank as reserves. And the further 90, that bank would be able to lend out to someone else who would pay them a return. So they would have a 90 asset being a loan. Remember, the loan to the borrower is a liability, but the loan to the lender is money that they can get back. It is an asset. The debt is an asset to the bank, just like the reserve is an asset to the bank. We show in this case that for the bank, their liabilities, their assets are both equal to 100. Now this is the simple example for a T account for a single bank taking a single $100 deposit with a fractional reserve banking system and R equal to 10%. We want to apply this very simple accounting statement, this very simple scenario, for a worked example of how having a fractional reserve banking system changes the money supply in the economy relative to a situation in which banks could not lend out money and simply acted as a place to store your money. That would be a full 100% reserve banking system. Now, if we have no banking system, of course, you can't put your money in a bank at all. So if we have no banking system at all, you have 100 in currency, money supply is 100. End of story. If we have a 100% reserve banking system, and you want to save that $100, you can lend that money to the bank. It becomes bank deposits. And then that money in the bank is part of M1 or M2 money supply. It's also part of bank reserves, but that bank reserves don't themselves influence money supply. We're not going to double count in that respect. So money supply, in this case, where you put your money in the bank where it remains, and the bank is simply a big vault that holds your money, money supply is still 100. It's not currency now. Now it's a demand or savings deposit, both of which will be included in money supply. So to note, if we have a banking system, but that banking system is a 100% reserve banking system, then the fact that we have a banking system does not cause any change in our money supply and doesn't cause any meaningful change, therefore, in our economy. What I look at is a more realistic fractional reserve banking system. Suppose, as in the example a couple of minutes ago, suppose we deposit our money in the bank, and the bank keeps 10 of that as reserves, but then lends that out to somebody else. Now, when they lend that money out to somebody else has 90 in currency. So we still have 100 in demand or savings deposits in the bank, which is part of money supply. And that other person who's borrowed the money from the bank, they have 90 in currency. So because of this fractional reserve banking system, the money supply is greater. As we calculate the total value of it, it's already 190. But it may not stop there. If that individual who's borrowed money from the bank winds up depositing that money in another bank, that becomes 90 in deposits. Or suppose they spend that money on something, and the person who they spend it on, the person who gets that money, they're the one who deposits that money in a different bank. When they deposit that money in the bank, that money is no longer currency, but that money is now a demand deposit. But the bank now saves 10% of that, 9, and they lend a further 81, 90% of that new deposit out. So in the second step, the 90 is saved, becoming an $81 loan, becoming $81 more in currency, increasing our money supply yet further by a further 81. As that money goes back and forth through the banking system, through the financial system. And the end result, as this money is deposited and lended, and deposited and lended, and deposited and lended, is that we'll wind up with a total of 100 in additional reserves, but 1,000 money supply. Our money supply in a banking system with fractional reserves will wind up being equal to the initial deposit, the initial amount of currency that was created, divided by the reserve ratio, in this case 10%. In this case, because our initial currency value of 100 wound up leading to 1,000 in money supply, so that money supply is equal to 10 times that initial value of currency. Money supply is equal to 10 times the value of the initial currency. It's equal to 1 over the reserve ratio times the initial value of currency. And we call 1 over the reserve ratio M, or the money multiplier. Here our money multiplier is 10 because our reserve ratio is 10% or 0.1. Now again, our reserve ratio can be influenced by setting reserve requirements. Maybe banks don't want to keep any more than they have to. So if we were to lower a reserve requirement from 10% to 5%, we might increase the amount of money that's being lent out, decrease the amount of money that's being retained as reserves, and we could increase the money supply. The money multiplier, if the reserve ratio were to go to 10%, from 10% to 5%, the money multiplier would go from 10 to 20, and we could double the size of the money supply. On the other hand, if we were to decrease the reserve ratio, the required reserve ratio, from 10% to 5%, we might find that not all banks wanted to decrease their actual amount of reserves held all the way to 5%. So a central bank's ability to control reserves isn't as complete as you might think, because businesses, banks, can choose to hold more reserves than the mandatory minimum, that reserve requirement. Perhaps they would prefer to hold 8% rather than 5%. Now, for a worked example here, suppose we look at a specific case where you find some money, and that's a sudden increase in the amount of currency in the money supply. And we look at what the impact will be on the overall money supply given different scenarios for reserves and reserve requirements. Suppose the Federal Reserve requirement is 20%, and we imagine that the actual reserve ratio is 20%. Suppose you find a $50 bill, and that's the initial increase in the size of the money supply. What would the maximum amount that the money supply could increase would be? And now, what different scenario, for different way that you were to use that money, what would be the minimum amount the money supply could increase? Now, the maximum amount the money supply could potentially increase would be to assume that the real reserve ratio is actually 20%, which is the mandatory minimum. It can't be less than that. And that you put that 50 in the bank loans out 40, that person who borrows 40, as that money filters through the economy, sends that money to somebody else who saves that 40, and then 20%, 8 of that 40, becomes reserves. The remaining 32 is lent out again. The maximum amount of money that we could have would be the initial 50 times a money multiplier of 1 divided by 20%, 5, 250 additional money supply in the economy, coming from our $50 bill that we found in the apartment. Now, the minimum amount that the money supply could increase would be if we didn't spend that at all, and we just kept that $50 in our pocket indefinitely. In that case, it would remain currency. It would not become a deposit and then lending, and then deposit and then lending, and then deposit and then lending, so that it could increase further. And the minimum amount that the money supply could increase would be 50. The initial gain in currency itself. Now, another way to phrase this would be that the change in the money supply due to your decisions, as opposed to due to the fact that you found the money to begin with, due to your decisions to put the money in the bank, could be an increase in the money supply of 200 relative to a scenario in which you simply kept the money in your pocket. Now, if the bank were to simply hold all of that money as reserves, the outcome would be exactly the same as if you had simply held the money in your pocket. And in both cases, while there's 50 additional currency relative to not finding that money at all, there's no change in the money supply beyond that additional 50 in currency due to the decision that you've made to hold the money in your pocket or your decision to hold the money in a bank with 100% reserves. Next, we want to expand this model or this example of a T account, accounting statement for a bank, and make it a little more complex, a little more complete, by incorporating additional assets and additional liabilities. So in addition to the reserves that the bank holds and the loans that the bank holds, they could also hold securities like shares of stock or bonds from governments or elsewhere. And in addition to liabilities as deposits from you, money that they owe you, they could also have as other forms of liabilities loans from other banks or loans from the government. They could issue stock, and that would be a form of liability, a liability to the owners of the bank, or they could issue bonds, which would be a form of debt. We would talk about a concept called bank capital as being the specific resources, the specific assets that a bank has because it has issued stock and because the ownership of the bank has put capital into it. Now, if we don't incorporate stock or the value of these equities that the bank has issued in their liabilities, then we would say that the value of bank capital is all bank assets minus the bank liabilities. It's the value of the bonds that they have, the value of the reserves that they have, the value of the securities that they have, the value of the loans that they've made, minus all of the deposits they've taken and all of the bonds that they've issued, all of the money they might have borrowed from other banks or from other governments. And that bank capital would be the value of all of these shares of stock, the value of all of these equities that the bank has issued. Now, one thing to point out before we move on, the value of bank assets can fluctuate, as can the value of bank liabilities. But the value of bank liabilities are much more stable over time than the value of bank assets. Suppose a bank has purchased shares of stock in other companies. Those shares of stock change in price and value over time. But if you have put money in the bank, so the bank has borrowed money for you for a fixed interest rate, then the value of that liability and the interest rate that they have to pay on that liability isn't going to change over time. As a result, bank capital will fluctuate over time depending on these relative fluctuations in the value of all of the bank's assets and the value of all of the bank's liabilities other than the bank's capital. Next to mention, if a bank wants to increase its ability to lend out money, to increase its assets, but does not want to increase bank capital, does not want to issue more shares of stock, this would mean that there could potentially be more profit to spread to fewer shares of stock, fewer owners of pieces of that company. It could increase profits per share of stock, or the profit rate of that bank. They can do this by borrowing money from other banks or by borrowing money from you, the saver. And we call the ratio of the funding of the bank that comes from this borrowing, be it your deposits or interbank lending, government lending, as opposed to bank capital, as leverage, or a leverage ratio. A leverage ratio, if it is high, might mean that a bank will be more profitable on a per share basis than a bank with a low leverage ratio, which depends for its ability to lend on bank capital. Now, if we look at this other sample T account from a more realistic national bank, that's what we'll name our bank. We'll name our bank More Realistic National Bank. We include as assets now reserves, loans, as in the previous example, and also securities, that's shares of stock and bonds and things like that. Now, as liabilities, we include deposits like we did before, the money that you've put in the bank, also debt, money that this bank has borrowed from mutual funds or from governments or from other banks. And now we also include bank capital. Now, bank capital is simply the remainder when we take the sum of all assets and we subtract deposits and debt. Now, as we calculate based on this balance sheet, a leverage ratio, it's the sum of all of the assets in the bank, reserves and loans and securities. Here's 1,000, and we divide it by bank capital of 50. So here the leverage ratio is 20, meaning only 1/20th of all of the funding from this bank comes from bank capital. Now, to see why leverage is desirable for the owners of the bank, suppose that bank assets, because bank asset valuations fluctuate, they're variable over time, suppose they suddenly appreciate, or securities go up in value from 100 to 150. So bank total assets go up from 1,000 to 1,050. This would increase bank capital, that's the value of all of the shares of stock in that bank, from 50 to 100, doubling the value of the bank. That's how much additional profit it would return to bank owners. Now, it doesn't increase total liabilities, obviously, by 100%. So suppose all of this bank's funding needs came from the owners of the bank themselves through bank capital. Then bank capital would be 1,000. Now, we will be changing bank capital now from 1,000 to 1,050 due to the increase in value of bank assets. And that would mean only a 5% increase if all of the funding from the bank came from bank capital, a 5% increase in the value of the company, a 5% increase in the share price for the bank. So the fact that the bank is highly leveraged with a leverage ratio of 20, as opposed to a leverage ratio of 1, which is the minimum it could ever be, means this bank is 20 times as profitable as it would be, or an individual share will be 20 times more exposed to fluctuations in asset prices as it would be if it had a leverage ratio of 1. Unfortunately, this also means that the bank capital, the owners of the bank, are just as exposed to negative fluctuations, losses in value for bank assets. Suppose that we have bank assets not increase in value suddenly from 1,000 to 150, or 1,050. Suppose that we have bank assets suddenly change in value from 1,000 to only 900. If we have bank assets suddenly fall in value to only 900, that might be because the securities that this bank has purchased have lost all value. They purchased shares in a company which has gone bankrupt. If this happens, it can happen because the value of these assets is highly volatile. Could also happen because they had lent money to a company as opposed to buying shares in a company which has gone bankrupt. They're not able to recover that loan. This would mean that total assets fall in value to 900, but debt is unchanged. And also deposits are unchanged. So the total value of bank capital would now be 900 minus the same 950. Now it's a negative 50. If the value of bank capital is negative, this bank is insolvent. This bank does not have enough money in assets to pay back all of its liabilities, its debts, to pay its debts to other banks, to governments, to mutual funds, and to give all of these depositors back the money that they've saved. In this case, the bank, which is insolvent, will cease to exist. It will fail, and some of that money will be repaid as assets are liquidated to those who have lent money or deposited money in that bank. Now, governments want banks to be relatively stable. Governments like the function that banks play in the economy, which is helping to match borrowers with savers. as we discussed in a previous chapter. And they would like to ensure that banks aren't liquidated, they don't suddenly disappear, and that savers are able to get their money back, etc. So governments want banks to be stable, but don't particularly care how profitable they are. Owners of banks want the bank to be profitable, but they don't particularly care whether it's stable, because the owner of that bank might own 100 shares of this bank, and 100 shares of another bank, and 100 shares of another bank, and 100 shares of an automobile manufacturer, and 100 shares of a tomato farmer, etc. They can be much more diversified so that they don't really need to care about the risk that this bank could potentially fail. They're concerned with average probability of profits for all of these banks that they might own shares in. So the owners of the bank prefer higher leverage ratios, therefore lower capital ratios. Governments, on the other hand, prefer higher capital ratios and lower leverage ratios, so they may institute requirements not for reserves, but for capital. We call these capital requirements, a requirement from a government that a certain portion of the funding of the bank, at least, must come from own capital. So if the bank finds that they don't have enough own capital to meet this capital requirement, they may be forced to issue new shares of stock in order to bring more capital, owner capital, into the bank. What we saw in the financial crisis in the United States a decade ago was that many banks were very highly leveraged. And when a few of those banks failed, people became worried, and other banks became worried that other banks might be likely to fail. And as a result, all of these banks, most of which had not failed, became unwilling to lend to each other and unwilling to lend to others. This led to a credit crunch, where it's very difficult for any business, any bank, any individual to obtain credit, whatever purpose they need it for, which made it more difficult for people to buy a home for which they need to borrow money, or more difficult for people to buy a car for which they need to borrow money, made it difficult for businesses to invest because they might need to borrow money, and it made it difficult for businesses that might need a temporary cash flow loan because their revenues are temporarily low to get a loan which would allow them to stay in business, and caused some businesses to fail, to go bankrupt, because they weren't able to pay their bills in the short run, even though in the long run, those businesses should have been stable, including banks and businesses in other sectors of the economy. So one response by the US government to this credit crunch caused by the fact that these businesses these banks had high leverage ratios, and they had seen drops in the value of their asset portfolio, one thing that these governments did was to buy shares of these banks. They forced these banks to issue new shares of stock, which the government would then buy, thereby putting capital from the government into the banks as new owner capital. So now the banks did have more capital to meet this capital requirement and should have been able to lend more money out. Unfortunately, what the US government found was that even though banks now had more money to lend out, they weren't necessarily as willing to lend this money out as the US government would have liked them to be. They were still worried that even if banks might now be solvent because they have all this additional capital cushion coming from the government, they're less worried that the banks won't be able to pay back the loan. They were still just as worried that other people, households, consumers, businesses, wouldn't be able to pay back loans. And they would prefer to keep this money as a reserve instead of lending this money out as an extraordinarily risky loan. So now we've established that a government could potentially change the money supply, if the government wants to change the money supply, by changing one of two things. Because the money supply is ultimately equal to bank reserves times the money multiplier. So they could change the money multiplier, or they could change bank reserves. And if they can change either one of these, they would change the money supply. Now, different types of federal policies, different types of central bank policies would target either the money multiplier by targeting the required reserve ratio, or would target bank reserves themselves by increasing the amount of reserves they have or the amount of currency in the economy that can be put into the bank. We'll talk about both of these in turn. Now, the primary way that the Fed and most other central banks around the world influences the money supply isn't actually to change the reserve ratio requirement, although this may seem like an easy tool to use. It's considered somewhat of a blunt instrument. What is usually done instead is something called open market operations. Open market operations are fundamentally simply purchases or sales of US government debt to banks or from banks by the Federal Reserve. Now, if the Federal Reserve buys government bonds from the bank, it gives them currency, depositing new reserves in that bank, increasing the amount of reserves that they have. We assume that that federal government bond that that bank was holding was sanitized and it wasn't able to circulate through the economy, being lent out again and borrowed again, etc. Then with more reserves, because the government has added more reserves into the bank through the open market operation, that bank can then lend out more money. When that money is lent out, it can be redeposited in another bank, where it can be lent out again, and it can be redeposited again. So the increase in reserves that comes from the open market operation times the money multiplier should be the change in the overall money supply that this open market operation would result in. Now, on the other end, it might be the case that the government wants not to increase the money supply, but to decrease the money supply. And the way that they do this is to force these banks to buy bonds from them, to take some bonds that are currently owned by the Federal Reserve and sell those bonds to the banks. Then this will take up some of the reserve that these banks have and force those banks to lend a little bit less than they otherwise would have, thereby reducing the money supply, because the money they don't lend can't then be deposited again and lent again and deposited again and lent again. Now, this isn't the only role that the Federal Reserve and central banks play. It's not the only way that the Federal Reserve and central banks influence the amount of money that these banks have available to use to make loans. The Federal Reserve and any central bank also acts as a bank. Now, if the Fed makes direct loans to banks, it lends it through what we call the discount window and charges these banks the discount rate. Now, the Federal Reserve or any other central bank can influence an interest rate or influence the money supply by making it easier or harder for banks to borrow money through this discount window at the discount rate simply by changing the discount rate. And the discount rate is an interest rate that's simply set by the Federal Reserve or whatever other central bank we're talking about. They could simply loan money out at a fixed interest rate of, say, 4%. They could also instead say that they'll make a certain amount of reserves available without setting an interest rate, and then let some type of an auction determine, let the market through an auction determine what ultimately the interest rate that's paid on these will be. And this would act in very much the same way as if they had set a single discount rate through the discount window and made any amount of reserves potentially available. Now, the more money that banks borrow from the Federal Reserve through the discount window, the more reserves they'll have available, therefore the more loans they can make, and the loans that they can make will circle through the economy again, becoming deposits, becoming loans, becoming deposits, becoming loans, increasing the money supply. If banks want to do more of this because the discount rate is low, they make more of these funds available, it's a greater increase in the money supply. If the Federal Reserve simply makes more available in some term auction facility, this would also lead to a greater increase in the money supply. Of course, the Federal Reserve or any other central bank can also influence reserves directly, and therefore influence the money multiplier directly by setting a required reserve ratio. If they set a reserve requirement of 10%, they can move it to 5%. If they set a reserve requirement of 10%, they could move it to 12%. But we generally argue that moving that reserve ratio, which is now 10%, if banks would really like to lend more, moving that to 12% can lead to a big, abrupt change in the money supply. And it might be too big and too abrupt for what the central bank wants. It may be difficult to calibrate exactly how much we should adjust it, and it might be easier to calibrate exactly how we might adjust changes in the money supply through an increase in the amount of reserves. Central banks around the world use required reserve ratios less than they use open market operations or discount window lending, also in part because when changing the reserve requirement works well is when we want to decrease the money supply. If we want to decrease the money supply, we can force banks to hold more reserves, and it will have a very strong effect in that case. They'll be forced to do something they don't want to do through this change in the mandatory minimum reserve ratio. Unfortunately, this doesn't work as well in the other direction. And central banks have an easy time and aren't particularly worried about finding new tools to slow down the economy by decreasing the money supply. They're much more concerned with finding ways to increase the money supply, speed up the economy, and combat an economic crisis or recession. But in these cases, banks already want to hold more reserves than the required reserve ratio. So the central bank might lower the reserve requirement from 10 to 5% and find that nothing happens because the reserve ratio is already 15%. It's another reason why we don't use the reserve requirement as much as other tools that are in the toolbox of a central bank. Next, we want to talk about another important phenomena in the banking system and some policies that have been instituted as part of the standard package of banking regulation, both by central banks and by other government institutions in the banking system. And this involves bank runs. Now, we note that the bank system that we have is fractional reserve. That means that the bank does have some money in it, but it doesn't have enough money in it that it could potentially pay everyone if everyone simultaneously went to that bank and demanded their money back. So if there are 1 million depositors, each has deposited 1,000 in that bank, if we have a fractional reserve banking system with a reserve ratio of 10%, only 1 in 10 of those 1 million depositors could get their 1,000 out. This is a problem. This makes people very worried that the bank might fail, because if the bank might fail, they would want to be the first person that got their money out before it failed. So they're worried that other people will go to the bank first, they'll get their money out, and after they go to get their money out, there will be no money left, and they won't be able to get theirs. What happens if everyone simultaneously rushes to the bank to get their money out because they're worried that other people will go first to get their money out and there won't be any left? That's what we call a bank run. Now, if people are worried about bank runs, it makes bank runs more likely. And if bank runs are more likely, banks will need to hold more reserves, both to make people less worried and to protect themselves against a bank run that does occur. For example, we might have a bank run that occurs due to some kind of a rumor about the solvency of the bank. That rumor could be inaccurate, and 15% of all of the depositors in the bank rush in one day to get their money out. If the reserve ratio at that bank is 10%, they could become insolvent. The bank will fail. They can't pay all of these people the money that they have to pay them. But if they have a reserve ratio of 20%, then they could give all of the money back to all of the people who have deposited there. All 15% of their depositors still have some reserves left and manage to convince other people that this bank will not fail and that they will be able to get their money back tomorrow. So now, Because the worry about bank runs both make banks likely to fail, which governments don't want, and because they force banks to hold more reserves than they would otherwise want to hold, which might be something that banks don't want and could cause the money supply to be less than it would otherwise be, or the government is targeting. Governments have policies that have been put in place since the Depression in the 1930s to try to make bank runs less likely. Generally, these work as deposit insurance schemes, whereby deposits that you make in the bank are insured by some government entity, some insurance corporation. And banks are then required to pay into this insurance corporation, insuring all of these deposits, just in case the bank were to fail. Now, this doesn't mean that because there's a deposit insurance mechanism that if there's a bank run, you'll be able to get your money out. But if the bank does fail, you would be compensated by the insurance mechanism even if you couldn't get your money out. This might mean you'd have to wait 6 months to get your money. That's unpleasant, but it would mean that you're less worried about not the bank run occurring, but the impact of the bank run. And if you're less worried about the bank failing, then everyone should be less worried that other people will rush to the bank to get their money out before it fails. So it should decrease the likelihood of a bank run. And it should mean that the insurance mechanism rarely actually has to be used, because banks would be much less likely to fail. And the last concept that we want to introduce is something called the federal funds rate. Now, if a bank needs to give money back to people who want to take it out today, reserves isn't the only way that they can do that in the short run. And if they need to meet a capital requirement, or they need to meet a reserve requirement on a daily basis to get back up to 10% from 9.8%, they don't necessarily have to attract depositors or issue stock. The easiest, quickest way for them to do that is usually to borrow money from other banks on a very short-term basis. And the interest rate that these banks are paying one another for short-term loans, that's lending excess reserves for one bank that has 10.2% reserves to another bank that needs them because they have only 9.8% reserves, and they both simply need to comply with that rule. The interest rate that these banks charge one another is called, in the United States, the federal funds rate. Now, this is a different interest rate than the discount rate, which is the interest rate that's charged by the government, by the central bank, when they are lending money to the same bank. Generally, the discount rate should be higher than the federal funds rate. And a bank would only want to borrow money from the government instead of borrowing money from another bank if it wasn't able to easily borrow money from another bank. Perhaps the other banks considered that bank to be a bad credit risk. Now, this federal funds rate, not the discount rate that the central bank directly chooses, is the interest rate that it watches most closely. And it's the interest rate it watches most closely to see if the things which it is doing, like open market operations, influencing the money supply, are having the effect that they want to have. So the government engages in open market operations. The central bank, the Fed, engage in open market operations in order to increase the money supply, believing that increasing money supply will mean more lending, mean more depositing, more lending, more activity in the economy. And they believe that when this occurs, because banks have more money to lend out, it will be an increase in the supply of loanable funds, and it should lead to a decrease in this federal funds rate. So what they would say is often not that we will increase the amount of the money supply by a certain amount, but that they will target a particular interest rate and say that we will increase the money supply until this federal funds rate falls from 3.4 to 3.3%. Now, the federal funds rate might seem to be only directly relevant to other banks because this is an interest rate which is paid by banks lending to other banks, but we can observe that changes in the federal funds rate are matched almost immediately by changes in other sorts of interest rates as well, which are interest rates charged to other types of borrowers. As an example, when we see the federal funds rate rise, we also see the mortgage interest rate rise. This is the interest rate which is charged to homeowners, people who would like to buy a house. We also see, as the federal fund rate rises, the prime rate rise. The prime rate is the interest rate which is charged by banks to the most reliable corporate borrowers, the most reliable businesses with the least credit risk. And we also see when the federal funds rate rises, the interest rate on government debt, here the 3-month Treasury bill or T-bill, also rises along with the federal funds rate. So by targeting or by watching what happens to the federal funds rate, indirectly, the central bank is trying to target all of the other more relevant interest rates in the economy because they all move together.